Let's get the take of Philip Petursson, Chief Investment Strategist at IG Wealth Management. Great to see you.
Good to be here.
So, of course, Bloomberg reports that, in fact, the markets have become less reactive to Trump pronouncements and threats, but we are seeing pressure on stocks today.
Yes, and I think it's a combination of a couple of different things. One, clearly someone woke up on the wrong side of the bed this morning and started to fire off tweets that could unsettle investors as we head into the weekend. But the second thing is, I think with the upward pressure of bond yields, that as well has been putting downward pressure on equity valuations, or calling into question equity valuations in the United States. And so these combination of things could result, or is resulting in, extra volatility that we're seeing this morning.
Is this a thing you think the market, I mean, it's very hard to read, but Trump, notorious for making pronouncements and backing off, I guess that's the art of the deal, but is this a thing that you would pay a lot of attention to, this escalation this morning in the trade war? Not
necessarily, because as you point out very correctly, that he has backed away from a number of these announcements over the past number of months. If you just try and keep track of everything that has been said and then pulled off and said and then pulled off, you would drive yourself crazy and you couldn't manage a portfolio that way. So you have to look at the broader macro picture with a little bit of faith that the intent of the White House is not to drive the U.S. economy into recession. And therefore, we're moving ahead at a decent pace. Growth is still going to be positive, slower than what we would have thought at the beginning of the year. But this is just another threat that we'll probably see muted or watered down over time.
Let's put up a 1 year for the S&P 500 and the TSX. You don't see stocks plunging to their April lows again.
No, exactly. We think that was probably the low point for this volatility period. There were a number of technical markers that happened on the 8th of April that would suggest that, yes, we've seen the peak pessimism being priced into the market. Not to say that we can't see a bit of a retracement. We would be completely within the norm of seeing what we have today extend into perhaps a 5% retracement from where we were just a couple of days ago. But the worst is more likely behind us as opposed to in front of us.
Bond yields, we'll have another look at those because, of course, that is ominous. When you see long-term bond yields go up, it tends to increase mortgage costs and funding costs for companies.
Exactly, and it has an impact on equity valuations as we pay attention to, because it's a teeter-totter. What is the value of an equity? Well, it's the discounted value of their future cash flows. Well, that discount rate changes as bond yields move up or down. If bond yields are moving up because the bond markets don't like this tax package that it has passed through Congress,
or passed through the House, I think it still has to get through
the Senate. Has to get through the Senate. Yeah. It's through the House right now, but it's been pushing bond yields up across a 10-year, 20-year, and 30-year. And then we had that softer 20-year auction the other day. That will then reset valuations on the equity side, which they're not overly expensive, but when you compare them to, if we compare the S&P 500 valuation to the TSX or to Eurostoxx 600 or to any other major indices out there, it's still at the top end. And it's still fairly expensive. So if you can find better alternatives elsewhere, cheaper alternatives elsewhere, I think that's what investors are doing, which is one of the reasons why I think the TSX has done so well in spite of some of the more volatile news that we've seen this year.
Yeah, because the TSX just hit a record high, even though energy stocks have not been thriving with this low oil price.
Exactly, and that's encouraging because we believe that oil prices are not likely to be sustained at this $55 to $60 level. They're probably going to move up over the next 6 to 12 months, and with that happening, that's another boost higher for the TSX.
Is Europe attracting you right now? Are you finding opportunities there?
It is. I mean, you have valuation in play, but then the question with Europe has always been, what is the catalyst to unlock the potential? And now we're seeing it with Germany starting to open up its wallet and spend more on defense or spend more on infrastructure. That's going to benefit the rest of Europe. Asia, we're seeing China stimulate more. I mean, it's been drip, drip, drip. But if they increase their stimulation, that benefits Europe more so than it benefits the United States. And so here, the combination of the two, if you think of the international markets overall, whether it's Asia, whether it's Europe, we think there's more upside to be had.
Maybe we'll put up Alibaba, BABA on NASDAQ. Just without commenting on that stock in particular, do you think China is set for a tech boom?
I think so. If you look at where China is leading, I actually had a great meeting with one of our colleagues based in China yesterday who was telling me that if you compare some of the great companies in the United States to their counterparts in China, the Chinese counterparts are leading and growing at a much faster pace. So with the discounts that we're seeing there, whether it's technology, energy technology, alternative energy technology, intelligent robotics, China is growing in these industries and in some areas leading.
It's interesting. DeepSeek shook up the U.S. tech industry. The Chinese are not behind in AI by any means, it seems.
Exactly. And this is what happens if you restrict certain technologies from someone. They will find alternative paths. They will innovate. They will invest more in R&D to leapfrog the existing technology. And that is what we've been seeing.
Yeah, that's the argument. You probably saw that from Jensen Huang, the CEO of NVIDIA. He said those chip embargoes on sales to China just encourage innovation in the Chinese market.
Exactly, and the stat that I saw yesterday was that China, they're spending more on R&D than many other countries out there in total.
Thank you very much, Philip.
Great pleasure.
Philip Petursson, Chief Investment Strategist at IG Wealth Management. Coming up, global bond markets are signaling that governments must pay more to borrow long term. It's not just in the United States. We're going to hear from Andy Brenner, Head of International Fixed Income at Nat Alliance Securities, on what's rattling the bond market.